Hi, welcome back to Academic Market Insights. I'm Dr. Russell Rhoads, joined by Dr. Larissa Adamiec. And today we're going to talk about something very timely. We're speaking in mid to early August, and the SEC just did something interesting with respect to financing data centers, which is an area that both of us have been focusing on an awful lot. The you know the whole idea behind AI is it's going to cost an awful lot of money, and money does not, as I heard a million times growing up, money does not grow on trees. So with that, I'm going to hand things off to Dr. Ademiec, and we're going to talk about where's the money going to come from and how can we track it, or can we not track it?
Right. So this was, I'm so glad that Dr. Rowe brought this up to me yesterday because I hadn't heard this and I was blown away by it. I know he was as well. And I think part of it is because we lived through the 2000 and the 2008 financial crisis. So when things happen and there's kind of like that smell test of like, ooh, maybe this doesn't smell that good. Maybe this isn't that great. This definitely felt a little icky when you first hear about it, and we dig deep, a little bit deeper. It still doesn't feel very good, which makes it something that I think is even more important for us to be talking about and thinking about. And the first question, I think this is important when we're starting to think about this, is what is a financial data center? Okay. And because we're going to talk about how some the rules and regulations change regarding the financing of these, we should understand what they are and what they're not. So, a financial data center is basically the operating system behind an AI system. So, it's going to harness the physical storage. It's going to harness the power to be able to do the computations for AI, and its business model is dependent on leases, contracts, the physical facility, the management of these assets. When we think about like an asset-backed security or mortgage-backed security, we're thinking about a system where we have periodic and predictable payments. This is not that. It's like an apple, this is a banana. They're not the same. They kind of look the same. They're going to kind of do some things, but this is not a passive pool of financial receivables. So when you think about a mortgage-backed security, to some extent, it is a passive investment because you know you're going to get on a monthly basis a certain amount of money. You account for a default rate and things like that. However, in here, there's a lot of fluctuations. And if a company is utilizing this financial data center, pardon me, and they go out of business, well, then the financial data center is now out that lease, out that contract. So there's a lot of fluctuations that go into this, and these are not global macro fluctuations. These are going to be individual fluctuations for their customers and their suppliers. And I think this is, again, important for us to really understand the scope of what we're looking at. We're looking at a substantial amount of um, capital that's required for some of these. One example is Data Bank, their financing history. This is how much they securitize in a year to year basis. You're looking at 658 million in 2021, and now in 2025 that's 1.1 billion. We should have actually we should have had a running total to go along with this for how much money that data bank is now financing just to keep operations up and running. So we now have much more demand on capital. And as that number keeps ratcheting up, it's going to have a cut into a bigger piece of the slice of the entire economy. So right now it's still small. I know we've talked a lot about other different asset classes such as private credit, which got a lot of excitement and a lot of buzz. However, we were looking at a very small piece of the overall economy. This is still a small piece of the economy. This is not mainstream. This is not what most institutional banks are doing or looking at. However, it is growing. which is one of the reasons why we're talking about it. And, and yes, Dr. Rowe.
They're already at 1.5 billion for 2026.
Whew.
This
And
is a
again,
private company, so you got to back into it from different data sources. But I can come up with 1.45 billion this year pretty quickly
and
without
again, this
digging. So it's probably higher.
right, and this isn't, again, we should have a running total to go with it
Mm-hmm.
because we're looking, that's how much they securitized in 2021. 330 was an additional three, I mean, 2022 was an additional 330 million. 2023 was an additional 715, and so on and so on. And one of the things that's really not discussed is, and I think this is important again, is just somebody who's lived through these crises, is what happens to data banks' creditworthiness as you're going on and on. Hopefully, they're paying off these securitizations in timely manners, but also once you start to get very over leveraged, we see bad things happening. We talk about other financial crises, such as long term capital management and how they over levered themselves. So, August 10th, huge things happened. The ruling of the securities, of these types of particular securities that are being issued, the securitization of those things we just looked at, has changed. So the SEC came out and said the fixed income or other securities issued in data center securitizations of the type you described in your letter are not asset backed securities. Okay, they are not. So under Section 3A 79 of the SEC Act of 1934, they describe and outline an asset backed security. Um, these securities have additional regulations than other securities. And I also thought was interesting, this now circumvents rule SEC Rule 192, which was created post 2008 financial crisis, which then created additional layers of conflicts of interest. So, for example, when we were thinking about Enron, right, and this Enron was 2000s, they had these SPVs, vehicle, special purpose vehicles, and what they would do is they would create an entity off of their balance sheet on another site and essentially sell it to this other corporation. And then they would be able to buy it back anytime that they want. So it's an interesting way to remove assets that don't look pretty off of your balance sheet and then replace it with an asset that does look pretty, which is cash. We always like cash. So we're now finding different ways to be able to get around some of these things. And that's one of the reasons why this rule is so important is particularly with Enron, those SPVs were owned by Enron employees. So we have this huge layer of conflict, right? So if the two of us create an SPV and I didn't like an asset and I sold it to you and you gave me cash, well, there's a lot of conflict of interest because we work together, right?
Mm-hmm.
Um, and the SEC said, no, we're not going to allow that anymore. Well, now these rules are relaxed. So let's take a look at before and let's take a look after. So before, when we think about our data center financing, we were thinking about them potentially treated like an asset-backed security. So, and again, any type of asset-backed security takes those steady stream of cash flows, deposits them here, and then rearranges them, and it's usually based on the ability to be paid off in different tranches. And those individual tranches are then sold to institutional investors. So we have this big collection of different assets coming in. The example I always liked best was David Bowie's music. So
Mm-hmm.
David Bowie's music, it has a catalog, and you're going to get certain amounts of revenue from playing their songs. And then let's say all the young dudes, I think that's one of his songs,
It is one.
is you could put that as one of the top tranches because it's going to get played more frequently than some of his other like b-side hits, right? And so those would be a lower tranche, which will have a higher payout but a higher likelihood that it won't get paid at all because nobody's playing that music, right? So very
I
similar
like
to
that.
what
I
we're doing
like
with.
that as a tranche example. I've never heard that one before, but I
I
like
mean, it's
that.
just a little more fun, but
Yeah.
that's again similar to what we're doing with the mortgages.
Mhm.
That's what we're doing with these cash flows coming in from the data centers. And now we're saying, no, 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 you don't have to follow all those strict rules. We're now saying you're not under that section. So those regulatory requirements don't apply. And again, as Dr. Rowe pointed out, these are not necessarily assets that are going to show up on the balance sheet.
Not.
So
uh,
it's much more difficult to truly value the company, right?
yeah.
And so
What?
looking into this, is this possibly a new fixed income asset class? And you got to say, what the shrimp? What are we doing here? What's happening? And again, this creates an interesting parallel. All of this, the goal for any types of these asset-backed securities is to take an asset, such as David Bowie's music, such as your car, mortgages, and then be able to repackage them to institutional investors. So an institutional investor, such as a very large investment bank, maybe Goldman Sachs, might be interested in saying, you know what, I want a piece of the American homeowner revenue. Okay. And so this is one way for that bank to get into that type of action because they're not going to, Goldman Sachs isn't going to go out and individually buy different mortgages from different banks. They want the whole package. And right now, AI computing, AI storage is a very hot area. And a lot of institutional investors want to get into that space. So this type of structure allows for that, but
Mhm.
allows for it without as strict rules. So we're taking that fluctuating cash flows. We're not creating an asset-backed security, but in fact, we're creating data center bonds. And again, the goal is for the institutional investors to have a vehicle to access those types of returns. So we're looking at transforming those cash flows into bonds that institutional investors can have. So it's an interesting parallel for what's happening and how some of the rules have relaxed, which I know causes me panic. In the 2000s, we didn't have such strict rules around these, as Warren Buffett called them, weapons of mass destruction. And there it's concerning what's going to happen next, especially if the SEC is saying, well, we're not going to watch them as carefully as we used to. So some of our key takeaways, we have a high demand of capital as we were able to see, and it's just going to continue to grow as more firms and more individuals adapt to utilizing AI. The changes in classifications of what types of bonds these are or fixed income products is going to change the structure of what the SEC is going to evaluate and what they need. And those relaxed rules always create, to me, these become flags. There's, I feel like I need to get a little bear's flag, waving the flag, like something's not right. It's stinky.
We usually don't go in that direction, so it's somewhat surprising. I'd love to know what the catalyst behind this or what entity was behind pushing this, because it you know I guess you had to be very close, paying close attention to pick up on this change. If anything, I feel like we should be going the other direction because this is such an emerging and risky field that you want more transparency. And the thing I had in the back of my mind this whole time was less transparency is just not good. And finally, I think we're at 50% internet bubble, 50% Enron. How's that?
Yeah.
How's
And
that?
it's interesting. Yeah, I completely agree. And especially given this is, I know, one of your favorite topics to discuss, that there is not a viable way for, or you haven't seen a viable way for these AI companies to make money. So
Not to generate the cat. And my understanding, and I don't think DataBank is one of these, but there are entities that are loaning money to build, data centers, And they're until the data center is completed, they're keeping the debt associated with it like off balance sheet, and then they will move it on balance sheet after once it's up and running, and they'll have that asset to offset the debt. You see what I'm so
Yeah.
it
Oh,
they're all riskier than they should be. I've got this long term thesis in the back of my mind that the spenders for AI, life's going to catch up with them at some point. And when you're having to pay for it, this is almost like opening up new credit cards and moving the balances around.
yes, it is.
How's that for? I'm trying to beat your analogy. All right, we'll
Well,
talk nice to everybody because they subscribe more when you talk than when I talk.
well, everybody, we thank you so much for joining us, and thank you for joining us for this such important, pressing topic. We would love to hear your comments, your thoughts. Do you agree with us? Do you think that, or do you disagree with us? Do you think that lack of transparency is good so that these firms can get the business done that they need to get done? Perhaps that's what you feel. If you have constructive criticism, I know there have been comments about my microphone and
Speak
not
up.
hearing me. So we took that to heart. I have a microphone. Very excited about that. If you have any constructive criticism about Purdue and Drew Bees, I'm going to say I'm a little disappointed. That's just a personal issue that I have to work through. This is a safe place to talk about Drew Brees. I'd rather you not bring up the 2006 Super Bowl. It's just painful. But if you like this video, please hit like. And if you haven't already, please subscribe. Thank you.